All right, everybody, welcome back to another episode, and we're going to give you an update for the June numbers of 2020 in 3, 2, 1. And there you go. There's a look for the new numbers for June 2020. We still have a couple hours left in the market, so this number for portfolio value will probably vary by a couple dollars. But there you go. That's how we've shaped up for the first 3 months. We started this portfolio at the beginning of April. I believe it was April 3rd. That's also when I started this YouTube channel. And so far, we have done very good for our annual income dividend growth and our monthly dividend income, and our portfolio value is doing very nice as well. And we will continue to make more and more deposits to this, and we'll be resetting the board in the next video, canceling all these out to zeros, and then restarting for the next month. So back to our portfolio. Every single month, at the beginning of the month, I make sure to give an update on my portfolio, what I'm thinking about selling, what I'm buying more of, changing any weight percentages. And as usual, those of you that are interested, if you like watching my videos and you enjoy watching my content and you're interested in using M1 Finance, I know this morning we actually got one more successful referral. We are now up to 11 successful referrals. Let's get that number up there higher. Be the 12th. This link is in the description of all of my videos, and be the 12th user that uses my successful referral so you can get $10 on getting started towards your dividend portfolio. Every single bit helps, guys, and in a time like now where deposits are hard to make, a successful referral of even just $10 does make a significant difference, and it does add up over time. So this morning, we did just make another purchase. I deposited $25. Right now, I'm only depositing about $25 a week for two reasons. One, I am cut down on hours at my work, and plus the market has went up so high that it's a little bit scary to deposit a huge amount right now. I think it's better to be a little bit more conservative while the market has gone up so high and we are in such a bad economy. But looking at my portfolio buys here, you can see I have 14 purchases, or about $27, and you can look at the list right there. These are the different companies that I purchased. But let's break down the reason that you came here. Let's go ahead and get started, and we'll sort by the highest value to the lowest value. We're up 18.76% on Broadcom. Broadcom makes up 8% of my portfolio, and Broadcom I still think is a wonderful, absolute great company to buy. I think it has started to recover quite a bit from the lows like a lot of these stocks has, but it still has a yield that is almost 4% and is due for another dividend payment. Broadcom is just set up so financially well for the future, and I think they have a lot of revenue growth, and I think that in the future that this is going to have huge gains for both the share price and the dividend as well. This has huge dividend growth. Over the last years, it's went up 98.86%, and the dividend growth is massive, from 40 cents all the way up to $3.25. Huge growth, massive growth there, and I'll be buying more of that stock in the coming month. So next up on the list, we have the second biggest in the portfolio. We're up 22.88%. That makes up about 7% of my portfolio. And next is Realty Income. So Realty Income is the only monthly dividend paying stock in the portfolio. It has a yield that is right about 5% after today's little drop, and it is still down quite significantly from where it was during the March lows. It hasn't really recovered much. It's went up just a couple dollars in share price. That's perfectly fine. I know I did a video recently where they received, I believe it was 93.9% of rent. So really the only sector that is really struggling so far for Realty Income in regards to them receiving their rent is primarily movie theaters and things similar to that in the hospitality sector. Other than that, all the retail stores, nearly every single one of them, are paying their rent just like usual, so I think the stock will do just fine in the long term. Their dividend is pretty safe. They have massive dividend growth, and I think that this is a great buy in the long term. If you're looking for a long-term real estate company, this is the best, most safest, most well-run REIT that you can find in the stock market. I made several videos breaking down deep into the stock, so if you're interested in that, go watch those. But Realty Income is a wonderful company, so go watch that and go buy Realty Income. The third stock on the list we have is the Southern Company. I've wrote down Southern Company before. They did just raise their dividend very recently. I believe it was this quarter, yes, so just a couple weeks ago. They went from 54 cents up to 64 cents in the last 5 years. They have over a 4% yield at 4.39%. This is a wonderful, wonderful utility stock. They've went up 30.8% in the last 5 years. And I think with how low they are still compared to where the prices were at the beginning of the year, you can see here $70, $71. They're a $57 stock. They have not recovered at all compared to what they should have. I think both in share price gains and in dividend growth, it's just going to be a steady uptrend, a slow ride up. You're not going to see massive growth with a company like this, but if you hold it for the long term, it's just going to be steady, consistent gains every single year. So if you're interested in that, buy Southern Company. And next up on the list, we have the fourth stock on the list, which is Visa. Visa, we're up 25.26%. It makes up 6% of my portfolio. And Visa, as I've mentioned before, is the lowest yielding stock in the portfolio by far. As of today's value, it yields about 0.57%. It has performed very well over the last 5 years, and its dividend growth is quite nice, from 12 cents all the way up to 30 cents a quarter. And I believe we're actually just received a dividend very soon. I believe we're about to get it in just this next week or so. But Visa, as far as share price gains go, there's not many stocks in this portfolio that I'm owning primarily for share price gains, and this is one of them. This is one of the very few, primarily three stocks. For that reason, we have Visa, Microsoft, and Apple are the main three that I'm mostly just focused on for share price gains. This is a stock that I think is going to have massive growth. This heavy uptrend for 177% over the last 5 years, I don't think that is stopping anytime soon. People could argue with high growth stocks like Apple. Maybe the best days are behind it. Who knows if people are going to continue to buy Apple stock? I think credit cards and debit cards are the future, mobile payments, stuff like that. I think Visa is going to be the dominant player probably long after I'm gone from this earth, and I think Visa is going to be an excellent investment with their share buybacks, their double-digit growth, their incredible margins, and there's so many things I love about Visa. So if you're definitely into growth stocks, and especially dividend growth stocks, Visa is the one to buy. I love this stock. Honestly, if this stock had a 2% yield or a 3% yield, it would be the number one stock in my portfolio. Above Broadcom, above Realty Income, this is the stock to go with. And then next in the portfolio, we have PepsiCo. PepsiCo, as you saw in my previous video, I just increased my positions in PepsiCo and Coca-Cola, and so I'll be breaking these down real quick. I'm up 3.84% on PepsiCo. It makes up now 5% of my portfolio. You can see the big jump there. I increased my position in it. It is down a little bit on the day. It now has a 2.89% yield. That's actually incorrect. We're about to receive a dividend next week, I believe. And it's actually has a yield that's over 3%. It hasn't updated because they just raised their dividend about 7%. You can see here it says 96 cents per share a quarter. It's actually $1.0225 a share, so that's about a 7% raise. Over the last 5 years, it's went from 70 cents up to that $1.02, so pretty good growth. 36% in share price gains over the last 5 years. And I think this stock, on a valuation standpoint, is still doing very nice. It has held up pretty decent through the recession. It has almost recovered all the way. But I think that this stock in the long term is always a great buy, just like Coca-Cola, so I'm going to continue to buy it. The next stock on the list is more of a higher yield, a little bit riskier stock as far as their dividend goes. And so far, we're up 12.46% on it. We're talking about International Business Machines, or IBM, which has a 5.16% yield. They did just raise their dividend just a couple of weeks ago, and they are a company that is currently restructuring their business, changing their business model to where they just recently acquired Red Hat, and they're going to cross-sell a bunch of their online platforms and increase revenues that way. I do think that this yield is a little bit riskier than on some of the other stocks that I own, especially for one that's this high in my portfolio, but I do think that they're going to be able to maintain that dividend. They are a dividend aristocrat, and the management is very focused to maintaining that dividend, as well as their new CEO, and I think that IBM is going to be able to keep that dividend, so I'll be buying more of that in the coming months. Next up, we have a stock that I'm up 14.61% in, and it currently makes up 4% of my portfolio. We're talking about 3M Company. I've brought this up every single time that I've showed my portfolio in all of my videos. It's down 2% of the day. This stock is an absolute dividend beast. It raises it every year for 62 years in a row. It just raised it again just about 6 months ago. It raised it up to $1.47, and it only paid out $1.03 5 years ago, down 1.69% over the last 5 years, so about break even. I think that the stock price got a little ahead of itself, probably quite a bit of ahead of itself, and it got really overvalued, and since then the share price has come down. That's wonderful. I'm glad for that because now I get a better yield and I get better share price gains in the future. With all of my stocks, by the way, not just with 3M, with all of these stocks, one thing that I hate is that my portfolio has performed so well and the share prices have gone so much higher from when I started this portfolio, is that it's kind of a blessing and a curse. It's great that I'm making money. That's awesome. But I want to see it come down because I'm not focused on this number. I'm not focused on the market gain. I'm focused on the dividends. I want these two numbers to go up right here, the annual dividend income and the monthly dividend income. The portfolio value will come along with it in the long run, but these are the two numbers I focus on. I want the share prices to come down in the short term so I can hold them for the long term, if that makes sense. So the same thing with 3M. I'm going to hold that stock for the long term, and it's going to do very well as I continue to buy it. The two stocks that I sold were Wells Fargo and Foot Locker. Wells Fargo I sold for about a 10% loss, and then Foot Locker I sold for about a 45% gain. And then Caterpillar, we're up 5.79%. We did just receive a dividend about last week from Caterpillar. And for the last 5 years, it is up 42.33%. It has a dividend that has went from 77 cents up to $1.03 per share, and they're due for another dividend raise. I'm really interested to see next month if they're going to raise their dividend or not. I guess we'll see. I know they're due for it, and they are a dividend aristocrat, so we'll see if they keep up with that schedule. What I care about is not if they grow that dividend in the short term this year, because I know things are struggling. I would be perfectly fine with a freeze on the raises as long as they kept that $1.03. I just don't want them to cut it. That's the main focus here. I do think if I had to bet one way or another, I think they'll probably raise it just because the management is so focused on raising it every year, and investors are expecting that, along with myself. But right now, they have a 3.24% dividend yield before that raise. And I think that this is definitely a stock that I'm heavily focused on the future for share price gains and dividends. I think that they will get through this recession just fine. And also, I made a whole video about them talking about the rumored infrastructure bill that Donald Trump might pass. And I think in the long run, regardless of whether that gets passed or not, Caterpillar is going to be an excellent stock for own for long-term shareholders. And I intend on holding that company for a very, very, very long time. The next stock in the portfolio is Coca-Cola. Just like with Pepsi, I increased my position. You can see the big jump a couple days ago there. I'm up 4.89%. And Coca-Cola is kind of interesting because it's crazy how well it hasn't held up in this recession. It was a $60 stock, 60 plus, and now it's still at $46. So down $14 a share. Quite significant from where it was during the bull market and before this recession. Over the last 5 years, it's only went up 13.59%. You all know Coca-Cola very well, what they sell, the products that they have. They went from 33 cents a quarter up to 41. They just raised it last quarter, and they're about to pay their dividend in a couple weeks, and they have a 3.45% yield. So buying Coke at these levels, if you're long-term safe dividend investors, if you're wanting to buy a stock like Coca-Cola, now is the time to buy it. When you're buying Coca-Cola at $60 a share, when it has a dividend yield that is under 2%, it's not nearly as attractive. But when you're buying it at a dividend yield of 3.5%, it becomes much more attractive. And I believe after today's drop, it's going to be over 3.5%. So Coca-Cola is definitely a stock that I recommend buying, and that's why I just increased my position in it. And if it drops more, I'm going to be buying it even heavier. So Coca-Cola is one that I heavily recommend for this portfolio. And the next stock we have is McDonald's Corporation. We are up 15.45%. It's 4% of my portfolio. And McDonald's, we just received a dividend today, by the way, and Realty Income was the other dividend that we received today. We received about $2 worth of claimed dividends today. And McDonald's has a 2.55% dividend yield. I know just like 90% of the companies on this list, they did just raise money, and I do think that they'll be able to keep that dividend. And they have held up reasonably well. They're still a $186 stock. I think that they'll focus a lot less on advertising and share buybacks and focus more on their dividend and surviving through this recession. When the shutdown ends, I think McDonald's will go right back to normal, and I think with their delivery services, I think they'll do okay. I think they'll do just fine. And in the long run, this is going to be another company that will do very good in the long term, and I think you should buy the stock as well, as I will be buying it in the coming months. Discover Financial Services. So this is definitely an interesting one. Those of you that watch my videos every time to the end know that I always update you guys at the end of my videos, and Discover Financial Services is the one that we are up on the most, and that is even after today's large drop. Even after today's drop, which is down about 2.49%, we are still up 66% on the stock. It is a 3.48% dividend yield, and this stock has absolutely done so well for us. When we bought it on April 3rd, it was at the little bottom right about here. Yeah, so we bought it under $30 a share, and now it's almost up to $50, not to mention the dividends we received. And I think that this stock in the long term is going to do fine. Who knows if they'll keep that dividend or not. I do think that it is in a bit of a higher risk section than we are compared to like a Coca-Cola. I do think that they do have a reasonable risk to cut that dividend. It's went from 28 cents up to 44 cents. And the problem with Discover Financial Services is during a recession, people default on credit cards like crazy. That is where Discover gets a huge amount of its revenue is from credit card services, and I do think that there is a big risk there. But if they don't keep their dividend, that's perfectly fine. I am so high on share price gains. I'll sell it for a 40, 50, 60% gain, whatever. But I do think that they'll be able to keep it, but I do know that there's definitely a pretty good size risk there. Meanwhile, I will be getting that juicy dividend along with the dividend growth if they're able to keep it. I believe they're due for another dividend raise this coming quarter, so I guess we'll see in the next couple of months whether or not they keep it or continue to raise it. The next stock on the list that we have is Waste Management. So Waste Management, we're up 17.85%. It's 3% of my portfolio. And Waste Management, I mentioned it before, one of the safest, most stable investments in this portfolio. Performed very well, 113.9%. The dividends went from 39 cents up to 55 cents over the last 5 years, almost a 2% yield exactly. And I think in the long run, Waste Management will do very well as well, and I do want to buy more of the stock. I just wish I could get the yield to go up because the valuation on this one is very high. It is very high. I think Waste Management has pretty much just went in a straight line up and has never had any kind of horrible things happen to the company. The one bad thing about this company is that their revenues are so steady and that their customers are so sticky that they almost have no hiccups. So the stock almost never goes down. It is pretty much a straight line up every single day. As far as a buyer's perspective, that is a bad thing because I'd like to see a big drop in share price so I could get it cheaper. But if not, hey, if it goes up, I'll continue to get my share price gains and my raised dividends. So that's great. And they did just raise that dividend last quarter as well. So Waste Management is an excellent one there. And the next one that we have on the list, we're up 24.4%. 3% of my portfolio. We have Mid-America Apartment Communities, one of the only REITs I have on the list. And this is basically just very, very simple, basic business model. Apartment homes. It's that simple. They own a bunch of apartment homes and they collect the rents off of those. I do think there's a big question mark right here going on with rents not being paid and consumers not being able to pay their rent other than their stimulus checks. I think in the long run, with jobs being lost as heavily as they are, I do think Mid-America Apartment Communities will probably run into some issues, but we'll see there if they're able to keep it. They still have a 3.33% dividend yield, and over the last 5 years, they're up 52.15%, and they've raised that dividend from 77 cents up to $1 on the dot. And I do think if I had to bet one way or the other, I don't know. Honestly, I think it's kind of, I'm on the fence on this one. I think that there's a pretty good chance that they'll cut that dividend, but if not, I would definitely love that as a shareholder, so I guess we'll see. Let me know down in the comment section what you think about MAA, if you think they're going to keep that dividend yield or not. So next up on the list, we have one stock that has performed very, very, very well as regards to their business model and holding up through their stock price through this recession. We're talking about Kimberly-Clark. We're up 7.45% on this stock, where it is 3% of my portfolio, and it has a 3.01% dividend yield. And this stock has almost not even budged through this recession, and the reason being, those of you that go into Walmart and when you see the toilet paper aisle completely, and I mean completely cleaned out to where you can't even buy one roll, these are the guys that benefit from that. These are the biggest profiteers from that. And Kimberly-Clark makes loads of profit from this recession when people are going crazy buying large amounts of toilet paper. They went from 88 cents a quarter in dividends up to $1.07, and I'm sure that is one of the safest in this portfolio in this type of recession because their profits are at an all-time high through the roof. Not only do I expect them to keep that dividend, I expect them to raise it dramatically next year once they get all that retained earnings stacked up. They have a 26.15% growth over the last 5 years, and I'm sure over the next year or two, this stock is not going to skip a beat. They're probably hit an all-time high, probably within the next couple months, if I had to guess. But Kimberly-Clark is still what I'm going to buy there because even with this excellent hold-up in share price, a 3% yield is still pretty solid. That's still really high. So as long as they held that 3% yield, I'll definitely be a buyer of it. I'll continue to buy Kimberly-Clark. And then next on the list, we have Procter & Gamble. Procter & Gamble is a company that I'm almost break even on. I'm up 0.58%. It is 3% of my portfolio. And Procter & Gamble I've been buying very steadily because they pretty much just traded sideways ever since this recession. They have held up very well. They didn't drop a lot during the big March lows, and they haven't really recovered a whole lot either. They've kind of been a lot less volatile than that of the S&P 500 or the Dow or the NASDAQ. And that is usually the way that this stock trades. It is so safe and so stable that a lot of its investors just wait for their dividend investments so they can reinvest those dividends. And then this stock has performed pretty decent over the last 5 years. It's up 46.3%. Its dividend has went from 66 cents up to 79 cents over the last 5 years, and it has a 2.57% dividend yield. in the long run with its dominant brand names, and you can read some of them down here with its baby wipes and its shampoos and stuff like that. I think in the long run, with this being such an old company and all the amount of huge brand names that they have, this is going to be a company that just has steady recurring revenues every single year, and I think Procter & Gamble is going to be one I'll probably hold till the day I die. So we'll see how that goes. The next one on the list is Microsoft. This is one of the three growth names that I talked about. I'm up 15.06% on Microsoft. It makes up 3% of my portfolio. We did just receive a dividend the other day, and this is by far one of the lowest yielding stocks in the portfolio, other than Visa. I believe it actually is the lowest yielding stock in the portfolio. It's went from 31 cents a quarter in dividends up to 51. And this stock is primarily focused on share price gains, hedge funds, retail investors, you name it. Everybody loves the two big names, Microsoft and Apple. People continue to invest in it. So if they keep up with this massive growth with their huge software development and cloud space like Azure, I think that this stock is going to continue to perform very well. And I think with the consistent dividend raises and the consistent share price gains through share repurchases and the huge revenue growth, I think that this is a company that you just really can't go wrong with. And I think one thing that I love about this company, just like Apple, even under this recession, they are thriving. They're not struggling one bit, and they are financially one of the most healthiest companies in the world. They are AAA credit rated, and I think that this is going to be an excellent stock for the long run. So next up on the list, we have Johnson & Johnson. Johnson & Johnson is much like a Procter & Gamble in the sense that they've held up very well in this recession. We're up 8.99%, and this stock currently yields 2.59%. And over the last 5 years, you can see, much like a Procter & Gamble, about the same percentage of gains, 45.3%. They've went from 75 cents up to $1.01. They just raised it this quarter in dividends. And just like Procter & Gamble and J&J, they just raised their dividend even in a recession, and they're going to continue to do that into next year. This is one that I'm not worried about cutting their dividends at all. Much like with Microsoft, it's kind of funny that they're back to back. This is the other AAA credit rated company that I own, and you can see here, they just hit their all-time high like 2 weeks ago. This is a company that's pretty much traded sideways for the last year, and I think that they will hit their all-time highs again, probably in the next coming weeks or coming months. And they have such steady consumer revenues that I don't think that there's going to be any holdup with Johnson & Johnson, as they have a lot of need-based healthcare products. So that is a very safe, stable dividend company with a 2.6% dividend yield, and I'll continue to buy that throughout this recession over the coming months and the coming years. One of the new stocks in the portfolio we have is Honeywell. We're up 9.02% on Honeywell. It is 2% of my portfolio, and it is a 2.33% dividend yield. It has went from 52 cents a quarter up to 90 cents a quarter in dividends, and I think that this industrial company is going to do very well over the coming years. I did make an entire video or two dedicated to this company, breaking down their financials. They have a cash position that is growing every single year, and then a debt position that is going down. And I think with their increasing revenues and their long-term growth perspectives, I think the management is going to continue to have this company perform very well, and that 46.65% over the last 5 years is going to continue to go up, and I think that the dividends are going to go up with it. So this is going to be a very safe, stable dividend investment, and I made many videos about Honeywell, so if you're interested in hearing more about Honeywell, make sure to go check that out. So next up, we have a bank stock, which is now the only one really in the portfolio that we have in banking, which is JP Chase. We're up 13.64%, was about 2% of my portfolio. I did just, however, sell my Wells Fargo position. I made an entire video dedicated to that. I think that Wells Fargo is going to cut their dividend. I'm going ahead and predicting it now, putting out my assumption now that I think that in the next 1, 2, 3 months, Wells Fargo will cut their dividend, but I think JP Morgan will keep it. They have a 3.5% dividend yield. They've went from 44 cents up to 90 cents, so over a double up in the last 5 years, and they've went up 50.85% in share price gains. I think of all the banks out there, I think JP Morgan is not only the largest, but I think it is one of the most better well-run banks. It is very old, and I think that they have such a large client base that I think they'll be able to keep their revenues high enough to be able to maintain that dividend. So we'll see there. I could be wrong. I know that all the banks are at pretty high risk here, but I guess we'll see soon enough. Next up is the highest yielding stock in the portfolio. We're up 3.91% on, so almost about break even, just a little bit up. It is an 8.5% dividend yield, and over the last 5 years, it has went down 24.35%, and the dividend went from 52 cents all the way up to 84 cents. And I think that Altria, I made some other videos breaking this down about why I'm holding it, why I think that there's a pretty good chance that they'll be able to keep it. I do know it is probably one of the highest yielding stocks in the portfolio and also one of the highest risk. I do know that there's a lot of risk there, but people that smoke are going to continue to smoke. They're usually very, very, very sticky customers. They usually end up smoking for years, for decades, or even a lifetime. And I think Altria will continue to get revenues from those. And now that they've written off a lot of the losses from their Juul investment, I think that this company is going to get back on track and they're going to handle that debt load and continue to raise their dividend in the long term. So we will see there. Altria, I'll continue to buy more of, even with that high risk dividend, because if I'm right, if they keep that dividend, an 8.5% dividend yield is massive. So next up is Apple stock. I said I had 3 growth stocks in the portfolio. I had Microsoft, I had Visa, and then last but not least, we have Apple. Apple is the smallest of the 3 growth stocks that I have. It's 2% of my portfolio, and we're up 29.96% on it. We did just receive a very teeny tiny dividend from it. And as far as dividend income, as you can see here on the list, Apple is the smallest in the portfolio. I only receive 48 cents a year, so about 12 cents every quarter now with the recent shares that I just bought. It has 0.97% dividend yield, so about a 1% yield, and it's went from 52 cents a quarter up to 82. Now the thing is, Apple is primarily focused on share repurchases over dividends. That is perfectly fine as long as they use their free cash flow in a positive way, as long as they don't piss it away, as long as they continue to grow the company. I think that Apple is going to be an excellent investment over the next several years. Much like I mentioned with Microsoft, the growth here is massive. If it keeps on this track, I can easily double, triple, quadruple my money over the next several years, and we'll see how Apple plays out. I think not only do they sell tons of Apple iPhones, but the one thing I love about Apple is the way that they diversified their revenue. They have revenue primarily through services now that is growing very rapidly, and primarily the Apple credit card is another thing that I love. Not only will they receive a lot of interest revenue from that, but it will also give them tons of consumer data. So that is what really interests me there. So Apple, I think in the long term, is going to be a very, very big share price gainer, and we'll see from there. Next up, we have Dominion Energy. Much like my investment in Southern Company, this is a basic, old, boring company like the Southern Company in the sense that they are just a utility company. Their business model almost never changes. I'm up 17.3% on it, and it has a 4.41% dividend yield. Over the last 5 years, they've went up about 18%, and they have from 65 cents a quarter in dividends up to 94. And I think in the long run, just like with Southern Company, this is so safe and stable, and the government regulates everything that they do. They're going to be able to determine their small share price gains and their small dividend increases. And it's going to be a steady straight line up. You can see here, other than their dip in 2018 and their dip now in 2020, it's just a steady, slow line up, along with their dividend going up and up and up. And I think in the long run, over the next 10, 20, 30 years, these utility companies are going to continue to perform very well. So we'll see there with Dominion Energy. And then next we have Qualcomm. The reason why I want to own Qualcomm is not only because they do have an impressive dividend yield. I'm up 14.81%. It's 2% of my portfolio. But the main reason I want to own Qualcomm, I mentioned my bullish thesis around Apple. But with Qualcomm, they are going to benefit massively, massively from 5G. And they are the #1 partner from Apple. They supply a bunch of the microchips. They're a semiconductor company. They went from 48 cents a quarter up to 64, I believe. They just raised it. They just raised it this quarter. They're about to pay in a couple weeks. I believe it's next week. But Qualcomm has only went up 10.64%. But once they really get the ball rolling and they start getting a lot of those revenues from those 5G phones that we've been waiting on, the revenues are going to be massive for this company. The gains are going to be ginormous, and I think that this is going to be an excellent investment in the long run over the next couple of years. Next up, we're down to our last 5 or 6 stocks. So we have AT&T, which is one of the higher risky dividend in the portfolio. We're up 9.7%, and it has a 6.63% dividend yield, and it has went down 10.75% over the last 5 years. Went from 47 cents to 52 cents over the last 5 years. And I think that with their massive debt load, they're definitely at a high risk. But I will be buying this company because I think they'll be able to keep it. Their recent launch of HBO Max, I think that they'll be able to survive this recession. And they'll do very well in the long run. So next up, we have Home Depot. This is a stock that has performed amazing. You can see the straight line up here. We're up 38.55%, one of the best performing stocks in the portfolio. It just hit its all-time high just last week. So this is a stock that has not only survived the recession, it is thriving in this recession. It's went from 59 cents to $1.50, and it is about to pay their dividend in about a week, and they have a 2.28% dividend yield. Home Depot has held up much better than I thought it would. I thought Home Depot would perform much like the others in the sense that it would probably be about this $200 range, Boy, was I wrong. It shot up all the way back to $250, and I'll continue to buy this stock, especially if it drops. But a 2.3% yield is not bad, and this stock has been doing very well as people are having more of their home projects being done while they're stuck at home. So, hats off to Home Depot. You performed a lot better than I thought you did. And then next up in the portfolio, one of the last stocks, we have Starbucks, which is one of my newer positions. Starbucks and Honeywell were my two newer positions. I made videos about them. I'm up 0.98%. This is one of the lower yielding stocks in the portfolio, about a 2% yield. It's went up 51.59%, and it has a dividend that's went from 16 cents to 41 cents. And I think this stock has really been overblown with the pain that it's going to feel from China and the shutdowns. I think that people have its delivery services, they have the app rewards, they're targeting millennials, it's in a high growth sector. They're one of their biggest competitors, Luckin Coffee, is going down the toilet, and I think that this company is going to thrive in the long run. One thing that I do like is that the management is focused less on share buybacks and growth and starting to focus more on the dividends. So I think in the long run, as they shift more and more to a dividend company and less of a growth company, I think the dividend growth is going to be quite substantial over the next 5 years. So we'll see there with Starbucks. I'm not a coffee drinker, but so many people are, as all of my friends and all the people that I know love to drink Starbucks coffee. One of the other telecommunications company that I own, other than AT&T, is Verizon. 2% of my portfolio. We're up 0.47%, and Verizon has a dividend yield of 4.39%, so very high compared to a safe dividend stock. Most of the safe dividend stocks in this recession are yielding 2%, 2.5, 2.8. This is yielding 4.4, and it has a dividend that's went from 55 cents up to 62 cents. I think that it's going to hold up just steady, and you can see it hasn't really went down a whole lot. It's traded pretty much sideways over the last year. It's held up very well, and I think a lot of people know that its recurring revenues from people that use its cell phone services is going to be able to maintain that dividend, and the company is going to do just fine even in the worst of recessions. So last but not least, we have NextEra Energy Partners. For NextEra Energy, we are up 34.34%, one of the better yielding stocks in the portfolio. It has a 3.96% dividend yield. It's went up 9.74% over the last 5 years. It has a 24-cent a quarter dividend up to 56 now. And I think in the long run, with NextEra Energy focusing on renewable energy and relying less and less on fossil fuels and things like that, NextEra Energy is going to be one of the main dogs to benefit from that. And that, ladies and gentlemen, is my entire portfolio one by one. In total in the portfolio, we're up 17.34%. We have 281 from market gain, $14.60 from total dividends, and in total we are up $296.05. And I'd like to thank you guys so much that watched it all the way to the end. I really appreciate it. We have 11 successful referrals, and especially for a YouTube channel that is not monetized, $110 is it's so much, guys. You might think that it might not make a big difference, but to me it means the world. It really does. So thank you guys so much that have used that link, and if you're interested, make sure to use it. You definitely make my day. So thank you guys so much for watching. If you have any questions about the stock I own or any questions about the market or just anything in general, make sure to hit me up down in the comment section. I'd love to answer any question you have. Thank you guys for watching, and I'll catch you next time.